Do you think metals and mining markets are more inefficient?
More inefficient. You know what's interesting? These names always just follow what the commodities do. And then you get periods where that just stops working.
Mate, we talk about what it takes to make a good commodity investor all the time, and namely, you've got to ride volatility through the cycle. We know that you've got to be patient, but there are these big, huge institutions, multi-strat hedge funds, which by definition are very short-term oriented. And thankfully, today, we've got just the guest to tease out why multi-strat hedge funds or pod shops are the worst way to invest in the sector.
Mate, this is a super exciting chat, and it's one we've actually wanted to have for quite a while. I think we're going to a large extent, try and demystify what is pretty foreign to a lot of the punters around here, right? So you might hear the words pod shop, multi-strat firm, these big hedge funds like Citadel, like Millennium, like Point 72. And we're going to speak with David Sparks, and he's going to try and help us answer this question and sort of share thoughts and share ideas around why they have such a tough time investing in commodity players, in mining companies, in natural resource companies, because of that vicious commodity cycle that a lot of the other investors we speak with try and make a winning from, right?
And David Sparks is one of the wonderful few people out there who has worked in one of these institutions. He's worked at Millennium, but it's not the only one that he's worked in this kind of hedge fund or multi-strat model, multi-manager model like several times. He actually started his career working for a hedge fund for the Bass family.
Yeah, famous oil family.
And these days he works for First New York, and he's got a more kind of discretionary strategy that he runs, but still investing in our favorite sector being metals and mining. And I think he covers some energy too.
That's right, mate. I'm excited to share this conversation.
David Sparks, thank you so much for joining Money of Mine. We're delighted that you're willing to have the conversation, sort of peeling back the curtain on the mysterious multi-manager hedge fund world, pod shops, multi-strat funds. They've got a variety of different names, but they have kind of taken over where capital is, what's moving markets, where a lot of the flow is. So we have to talk about it. There's an intersection in metals and mining. You've worked at multi-strat hedge funds. You spent 3 years with Millennium, and that wasn't your only visit in that world, but you've seen the light, and you're now obviously working prop shop instead with a lot more discretion. What is a multi-strat hedge fund? What is a pod shop?
The rise of the multi-strat, it has been 20 years in the making. I think a lot of people know the big names being Millennium and Citadel and Point 72 and whatnot. But it's a grouping of a lot of different types of strategies. The idea being, if we put a lot of smart people together that run money differently, we can approach the efficient frontier of returns and offer the best risk reward to our investors. That's the idea.
And how did you find yourself, Dave, in one of these with a metals and mining lens? Because we always hear that metals and mining is a incredibly small market, and you're in the States. So you found your way to investing a bit of money in this specific sector for a multi-strat fund.
Yes. So they're always on the lookout for talent, and their assets have been growing very steadily for a very long time. I had been working for a portfolio manager for a wealthy family for the first 7 years of my career. And then he got interest from Millennium, and they kind of made him an offer, and we went over. When they throw a bunch of money at you, you take what you were doing before and you say, okay, I can do that there. And that's how that whole thing happened.
The model of these multi-strat funds it's so different to what you can be used to anywhere else, right? Like the risk overlay, the way that capital scales in accordance with performance. But that model has enabled them to accrue so much funds under management, and now they're such a force in our markets. But when you're going from a more discretionary strategy to and then applying it in a multi-strat world, like how did that pan out?
How'd that go? It is not entirely different from what you would do at a traditional long short, but there's a lot more emphasis placed on risk controls. I mean, they have a prescriptive formula that they try to provide to management teams. And that really isn't how to say this. You're fitting a desired volatility construct into a portfolio. So with the technology or consumer or utilities, it's pretty easy to fit into like what exposures you're taking. How do you define your idiosyncratic risk? Where it gets trickier, I think, to the point of your question, with mining or energy or something with commodity risk, is how do you define what idiosyncratic risk you're taking and do it in a kind of neutral way that's not going to put them at risk, right? Because I mean, their whole game is growing assets, generating fees off those assets, and what they're doing is putting a lot of leverage on that capital. So think of it, for every dollar that they get from their investors, you're probably putting $3 to $4 long and $3 to $4 short into the marketplace. So if you're a 10 billion fund, you might have 30 billion long, 30 billion short, spread across a number of teams. If you lose money, if a couple of teams start losing money, that creates a huge problem for that asset base and the returns to the investors. But the idea is like, all right, if I have 20 smart teams and I can tell them, all right, fit into this risk model, and as long as you stay within this risk model, which we've figured out is what's going to keep your volatility down, then you're smart, you're going to have your alpha, and we're going to be able to generate returns with a ton of leverage that's going to look amazing to our investors. The issue with that is the incentive structure of the management team of a multi-manager. Then you have the incentive structure of like the portfolio manager and what are they trying to achieve. And your investing style may not necessarily align with wanting to fit perfectly into that structure. Whereas you can be much more risk-seeking, willing to ride out more volatility in what's happening with your positions and your theses because of the leverage employed in the system.
Dave, can you just expand on the neutral component?
Yeah, so there are a number of factors that these guys are looking at, and it varies by firm, like how intense the factor models are, whether it's value or growth or momentum or just beta. Like some firms are very focused on having you like very factor neutral, where your longs and shorts kind of cancel each other out. So your exposure to the value factor would be zero in essence. But if you build a portfolio where the positions you like, the bets you want to take, create an imbalance, then they can either tell you you need to cut the positions, or you start forcing in other positions that you don't necessarily want in your portfolio just to hedge out some sort of factor risk. And I think that's where a lot of people tend to get frustrated with the system, if they are frustrated with the system, is that you can spend time forcing positions that you don't necessarily want in a portfolio, which can be often dilutive to your process, your alpha, your time. That can be one of the significant frustrations.
The whole model, it's looking to reward alpha, right? And you, as a portfolio manager, will have some insights. You express them with certain longs and shorts. Maybe they get hedged out. But if you're roughly kind of neutral in some respects, then that idiosyncratic insight should be rewarded as alpha and you get remunerated accordingly. Is that kind of a fair characterization?
Yeah, that's basically the idea. And also your comp at the end of the year, there'll be a baseline percentage that you're paid, but that also scales generally with most firms based on how well you perform relative to a risk model.
So the model itself is fantastic for endowments and all these sorts of big institutional allocators of capital because the risk parameters are so tightly controlled and all these sorts of things. So they can give money to it and they're happy when the model works.
Sharp ratio.
Sharp ratio.
Yeah.
But if we look at it from the other lens of financing mining companies and financing assets to get them built and get them off the ground, there seems to be a bit of a disconnect because the duration that needs to go in and the volatility often inherent in financing mining projects is, it's hugely volatile. So how do you marry those up and you sort of sitting in between making that work?
You don't. I think it's one of the interesting things, right? Is like the multi-managers are so large and you're so active in the market trading that you generate tons of commissions that you pay to the street, which means you have world-class access to management teams. So you end up getting to know management teams incredibly well. And that is one of the largest benefits of working in a place like this. However, because of the risk model, you are forced largely into being a trader, especially in a space like ours, which is so volatile that you have to constantly be monetizing positions. And if you're talking about financing a mine and taking a long-term view on something or riding something out through a period of volatility, I mean, I'm thinking about my own experience in 2015 trying to ride out Glencore through everyone thinking it was going bankrupt at the end of that year. That is not viewed favorably. So to your question, very difficult to marry those two ideas. Management teams get amazing access to these investors, and I think they tend to enjoy conversations because, there's a lot of talent. There's a lot of very smart people that work at these places, but they are not your typical cornerstone long-term shareholders.
Talk me through this Glencore period.
Oh,
What was your trade?
so 2015, not a positive time in our markets. One or two of the trading houses were going bankrupt. I think it was Noble Group that was having issues, if I recall. Everyone then looked at Glencore and said, oh, Glencore's got a trading business. Glencore's going bankrupt. Glencore's CDS was blowing out in the fall of 2015. Ivan's coming to town, and this is a great part of working in multi-manager. You have access to Ivan. Got to sit down a couple times. Hey, what is your trading business? Like, from my understanding, you move coal from here to there, and the duration is very short. You should not have a financing problem. That got reiterated a number of times. Okay, understand this. Like, you're not actually going to go bankrupt. Trying to explain that when CDS markets are telling people otherwise became a difficult discussion to have.
How do you manage that volatility then in 2015 as the ultimate kind of bear market for commodities where everything's like, do you get forced out of a position early or?
I mean, that's what happens. You get forced out, you really have to shrink, you force on bad hedges. Yeah, I mean, anything that you shouldn't do or that you wouldn't want to do.
We see this like justification about volatility in markets these days when there's unexplainable volatility, like fingers get pointed to a pod shop blew up, and it kind of feels like an explanation just to explain something away, but it is a real phenomenon too, right? Like, what does that look?
Well, think of it as a kind of like a cascading factor, right? Where there's so much money, and a Millennium might have 10 teams trading one sector, and Point 72 will have a couple teams, so we'll have a number of teams. So you have all this capital flowing into a sector, and especially if the sector is small, you can get very crowded positions. If you look at the factors to watch on Bloomberg, if you look at a 10-year return profile, the best performing factor is earnings momentum, which makes a lot of sense. What hedge fund analysts are trained to look for and invest in are positive earnings revisions and short negative earnings revisions. When you throw a lot of very smart people looking at the same set of data, you're going to get a lot of people that come to the same conclusion, which means that a lot of people are going to get stuck in the same trades. And then if you have some exogenous factor happens and someone needs to gross down, or someone's book of some size is getting hurt, and now they're getting hit by the risk department saying, hey, you just triggered a drawdown limit. We'd like you to cut your book. All right, now you have an indiscriminate seller. Like, they just have to sell. So someone starts selling, and there's no fundamental reason why you'd sell that stock, but like, you just have to cut your book. Well, that may put pressure on a stock down 4 or 5%. And then someone else is looking and says, why is this position down? Now their performance is starting to drag. And they're thinking, oh, well, I can't take this pain anymore. Now I have to sell. And that's how it kind of becomes a self-fulfilling prophecy until the selling stops and it's exhausted, like, oh, the books are grossed down, or someone with a bigger checkbook says, I'm willing to take the other side of this.
How do you think about it now, Dave, after having been in that side of the table and witnessed how things play out? In your new role, do you take a more patient lens and know, hey, this earnings momentum being the sort of method you mentioned there, like, hey, I can be a bit more patient. These guys are going to slam it. But if I can take a 2, 3, 4, 5-year view, there's real money to be made, while the kind of street and or the multi-strat shops hate this stock for whatever reason in the short term.
Yeah, I think, when you're given freedom, you can take advantage of that. I mean, like now, having listened to Neil talk about Ivanhoe and listening to their webcast last week, Ivanhoe seems like a very mispriced story. Obviously, this is something that's going to take a little time. And for someone in a different seat, right, like, that's still messy. Like, you don't know what the new mine plan looks like, what next year's production is ultimately going to look like. So you can't actually say with comfort, oh, I understand how this earnings trajectory is going to move. Whereas I'm sitting here and saying, well, Robert Friedland doesn't really trade at a discount ever. And he's got Western Forelands and Zambia and Angola like sitting there all waiting to get proved out. You're going to fix whatever this mine issue is, right? I mean, I would hope so for their sake. And you can, in a world where every single mining company wants more copper, I'm sure there'd be tons of people wanting to buy Ivanhoe 50% up from here, but Robert Friedland's not selling Ivanhoe 50% up from here. He's probably thinking it's worth a lot more. So, but yeah, I mean, being able to say this is a value disconnect and I can sit on this for a bit is nice. Now, you could do that at a multi-manager as well, right? But like, you're just keeping that position size a lot smaller, and it's not necessarily going to really move the needle for you.
Why is it smaller? Can you tease that out? Is because the event catalyst is so long dated and it's a gradual thing?
You can't determine when it's going to work with any sort of confidence. So because of that, you just can't size it up.
Gotcha. And the whole kind of betting and position sizing around events, it can be kind of drastic to the other side as well, right? If you have some unexpected volatile shock in a big size position, then that's where things can go pear-shaped.
Thanks beginning of April and Trump's tariff announcements. I mean, that was just pure gross down behavior for 2 weeks.
Yeah. When you and I first connected, Dave, before we even jumped on a call, you sent me this message, and I said I'm curious to learn more about the multi-strat, like New York hedge fund world, and I'm pretty unfamiliar from it. And you replied and you said the worst way to make money in the sector. And that kind of stuck with me. It resonated for a lot of ways, because you look around our sector and it's created some phenomenal wealth for many people. But the people that got rich, they got rich by taking entrepreneurial risk. They were patient. They had the long-term outlook. They maybe backed geological alpha as a strategy. Maybe they had phenomenal kind of like long-term patient stock picking ability. But the common theme amongst it all is you had to stick with it through the volatility. And definitionally, like a multi-strat hedge fund can't do that.
Yeah, I think the other piece of that is concentration, right? Like,
yeah.
You make money by betting on something in a major way. You make money at a multi-manager too. I'm not discounting the wealth generation there, but if we're talking wealth generation.
You can be a millionaire at a multi-strat hedge fund, but you're not going to be a billionaire like some mining entrepreneurs can be.
Yes. Yeah. I mean, there is a difference. And I think it's a difference in your personality makeup, your style of who you are and how you think and what you want. You know, there are a lot of merits to it. But again, if you want to swing and that's your personality type, then you can't fit a square peg into a round hole.
What are the other parts of the strategy which may be like useful or applicable to other sectors, but there are inherent limitations when you look at it with the, the mining or commodity lens?
Yeah. So I think, when you go back to why these have been so successful, you go back to the early 2000s when these sorts of funds were really getting started. You actually had a lot of money getting made in utilities. So, I mean, think about the market is really just every single day, who are you arbitraging, right? Like, where is the information asymmetry and what are you taking advantage of? And you go back to like early 2000s with utility hedge funds, and they were arbitraging like long only money that wanted a dividend and really wasn't doing a lot of work on what was going on with those companies. Then you throw a bunch of like really smart hedge fund people with a lot of time looking at fuel clauses and how CapEx was going to change rate base and change earnings trajectories of utility companies, which seems like, very nuanced, but it made a huge difference. And you would have these gaps on earnings days where people went, oh man, I didn't realize that was going to happen. So that's where you had true information asymmetry and where you saw a lot of alpha generation and why this became so attractive. These days, right, like who you're arbitraging has entirely changed. It's not the long onlys really anymore. Like so much money has moved to the multi-managers that you're kind of arbitraging each other. And it's what did you hear? Like what data point just came out from that conference? The management team said what, and now I need to reconfigure what I was thinking for this quarter. And, if you talk to a management team, a complaint that they would have when they talk to some of these pod shop analysts in meetings is the questions, sometimes revolve around like what's going on with your business, but it's more like, how's this quarter looking? Like, what's in my model? Like, how do I fix this? And that's where the arbitrage has kind of moved to, which is just different.
And you invested globally, right, Dave?
Yeah, that was exhausting.
Did you notice this phenomenon was much more pronounced in the States than it was perhaps in other markets? Or by this point, is it pretty equally seen everywhere?
Every market's different. The US is different from Europe, is different from Australia. Australia always felt like you really needed to be there to know what people were getting excited about. There would be days where I would not understand why Fortescue was moving the way it was. And it was just like, wow, everyone's really excited about iron ore right now. But yeah, I think still every geography is kind of its own animal.
I want to talk about the shorting component as well, because we've talking about the difficulties in staying long and being long and sizing that. But shorting is this kind of dark art, and I think it's kind of simplified a bit here. I think the nuances and just how difficult it is a bit underappreciated. Can you sort of give a bit of color on just how difficult it is to sort of stay short, the various costs you have to pay to just have a position on short, and what the difficulty is in staying on that side of the trade?
Yeah, I think it depends what you're shorting. If you're shorting something where everyone else is short, that's where the cost and the risk is. Like shorting lithium stocks now. If you have a bunch of people short, you tend to pay more in borrow rate, which means you are paying to think that it's going to go down. And that's where that can kind of create a problem. And So that's kind of where your cost is. The painful side of that is you may be looking at Albemarle and say, like, Albemarle has no cash flow right now, and everyone is at this fast markets conference falling over themselves to say lithium's oversupplied until 2030. No, it's 2033. And lo and behold, Albemarle is up 7.5% at one point today, and has gone up 15% in like 4 days. So that is a function of the fact that probably a lot of people are short. You can't take the pain because you start losing money. Now you're like worried about that drawdown limit and having your capital cut. So one person starts to buy, cover their position, and then that becomes reinforcing and you get the short squeeze. So that's kind of where you have your cost, is you have that risk of a short squeeze on a crowded name. And if it is a crowded name, you can tend to have to pay for the right to borrow it. But otherwise, I mean, if you want to short BHP, it's not going to cost you anything. It's not going to hurt you. It's not really going to move. Like that tends to be a very like dummy type placeholder short that people would use.
When you're borrowing shares to short, sometimes the party that you borrowed them from can demand them back as well, right?
They can pull them back.
They can pull them
Yes.
back. Yeah, that's a dynamic that I didn't understand until recently.
Yeah, so I mean that you can have shenanigans like that if you're trying to be cute and short something with $500 million market cap.
Yeah.
Well, if someone decides to pull the borrow on a small company, that can have a very meaningful impact. Shorting something that is small tends to not be the best idea in the world.
I'm curious to tease out. So how do you get like, for every dollar invested, like $4 long and $4 short? Like, how does that work?
That's set up with prime brokers. So they'll let them borrow against that and against your asset base. And they're working under the assumption that because the lack of risk that they're taking, they're very comfortable lending out a lot of money.
Lack of risk. It's a funny word, right? There's like this, I guess, inherent assumption that, like a lot of these different risks are being hedged out, and all of the various pods are all in independent views. There's not it's diversified portfolio risk as opposed to magnified and amplified. But do you also think that there's like big cascade kind of risk that can enhance a lot of market volatility as a result of?
There's huge hidden risk, right? I think the multi-managers had a huge issue during COVID. I think March 2020 was very scary for a lot of funds. You had a lot of PMs losing money. You're looking at returns going negative and wondering, if you're levered, how are we paying this back? Given the amount of leverage in the system, there's an inherent risk that's sitting there every single day.
You spoke as well before about having potentially a number of teams or a number of pods looking at certain sectors. How did you always feel sitting within a metals and mining kind of team within a bigger shop? I'm sure tech would have had way more pods kind of allocated to it. How much attention was paid to the metals and mining space in these New York funds?
You get some. I mean, look, it's niche. There generally is not a ton of interest for people looking for mining. And I think it's also changed a bit in that the space is not nearly as liquid as it used to be, which makes it a lot harder because they have vast amounts of capital, right? And they want you to put it to work. If you're not comfortable because of a lack of liquidity to have a $30 million position on something, then you're kind of constrained. So that's kind of the governing factor, I guess. What is the market cap of your space relative to the overall market? That tends to be how teams are constructed. You're obviously going to have way more tech than you will mining or energy. There was a problem years ago where you were overrepresented in some of the smaller sectors like energy, and you had many more teams than you should have had for the market cap, which then created that phenomenon of increased crowding and greater risk from everyone being on the same side of a trade. The beauty is you get to meet with management teams, you get access, However, when you are at one of these bigger places, you often have to share meetings. So that can be fine, but if you're trying to work on a thesis and flesh something out with a management team, you don't necessarily want to share the meeting because maybe you're educating someone who's a competitor, ultimately, even though you work at the same fund, and you're trying to create this alpha in your head is like, okay, I think this is an idea and I want to work towards something, and then someone is getting a free ride on what you're working on. And that can create a bit of an issue where people get competitive with who gets meeting spaces.
The access to management is an interesting part, right? Like remarkable access to the C tiers of these mining companies. But isn't it kind of like, it's an odd thing because you're a hedge fund, you're not like, you're going to buy 1 week, sell the next week. Why is Millennium afforded such phenomenal management proximity when they don't care about holding the stock for too long?
It's just how much you pay. It's the sell side that is orchestrating all the access.
Yeah, and you pay fees.
And you're the one paying them all the money.
Makes sense.
Yeah. Who are the management teams from your time working there that really left an impression? There are a few names that were running some of these big companies that you were kind of wowed by?
On like mining management teams that I got access to, Ivan was very impressive. The whole Glencore team was great. Mark Bonnet was very impressive. Obviously, the koala just wrote something about what he thinks might happen there, so that'll be interesting to see if that plays out.
That'd be wild. Yeah, I reckon low probability on that one, but yeah, maybe the koala knows more.
Well, Rio's such a mess at the moment, as like that would be quite the turn of events.
Yeah,
but that was top of my head. Those would be the names that I went with.
Yeah. If you had no constraints on like investing in the sector, let's say you had $100 million of personal capital, how would you deploy your own personal capital without any institutional constraints? How would your strategies be different to them?
From what I'm doing right now, not different at all, really. It's kind of blending a medium-term thought process and monetizing as necessary on the trades. I mean, I've been in First Quantum since March of last year, and thinking that Panama has to come to the table.
It's coming back. It's coming back.
Well, Chiquita just left Panama, so that might be becoming more important. I've traded in and out of that a ton. I think when you can blend, this is my style, but when I'm able to blend a longer term thesis with short term monetization and not have to worry about, oh, my copper length is too long here. Well, that's the risk that I want. That's fine. If I want to hedge out copper, I'll short a copper contracts, which you may not be able to do at a multi-manager. Maybe you have to, force a copper company short. And, if all the copper companies are cheap, then that's not what you want to do. So yeah, it's really just having the flexibility to take the actual risks that you want and not forcing risks that you don't want.
You mentioned a change in liquidity over time. How else have you seen markets change over your time participating?
The crowdedness aspect has entirely changed. I mean, when I entered the business in 2007, that was not really something that you even thought about. I would say really 2013, 2014 is kind of the first time that we really started to notice, hey, you're getting these weird gross down events where I don't know why this is happening, but positions that you like, I like, I mean, we all like this, why is this happening? And so that I think has been one of the biggest changes. And that's just been a result of where the capital has gone and the different makeup of the investor base trading in the stocks. In our world where things are not as liquid as they used to be 10 years ago, you throw in the fact that even more smart people are looking at the same ideas, that creates dislocations.
Do you think metals and mining markets are substantially more inefficient than other markets?
More inefficient. Yeah, what's interesting is that on a very simplistic basis, these names always, like, for most of a period of time, will always just follow what the commodity's doing. There's very little, unless you're talking about a developer where you're actually getting NAV accretion. And most of these things just follow what they should be following. And then you get periods where that just stops working. And you look at this and think, well, this is going to correct itself. Like, if a copper company hasn't done it, nothing bad has happened, and it is dislocated from what has happened with the copper price times its projected production, why has this happened? And you get periods where the market just misses things or overreacts to things. I think about Goldfields last year with Solaris Norte, and their pipes froze in Chile. The stock was down like 15%, like 3 billion or something like that got taken off the market cap on something that was going to be a handful of months delay. And, based on what they told you, like, okay, you lost a couple months, you're going to lose a couple $100 million in gold sales. Well, the market just took you down like $2 billion. Clearly we overreacted here. Like, what are we doing? And, within 2 weeks, stock's right back up 15%. So you tend to get periods where you get a lot of overreactions, and it's really, is this going to happen? Is it going to correct tomorrow? Or in the case of Ivan, is this going to take a couple months? You just don't know.
I can't let you go, Dave, without asking you about maybe some of your more recent views you've been fleshing out lately. I spoke to you on the phone maybe like 3 weeks ago, and you told me Sigma was looking pretty cheap where it was, and then within a week it had popped 20%. So I really just need a tip.
First Quantum's working a little too well at the moment. Sigma I still think is interesting in how you structure the trade. As what I was trying to do was sell a long dated put at $3, which was going to give me the right to buy it at like $2.60 a share, which is essentially going to be, you're going to be buying it at 580 spot, and then taking the proceeds from selling those puts to buy calls at 10, thinking, all right, if you go back to some sort of cost curve at 800, Sigma goes back to 12. So that to me was like an interesting way to just think about how you could maybe structure a bullish lithium bet, even though I'm not bullish on lithium. The name that I think is most interesting right now, which honestly I hope is going to pay off before this podcast gets released, is Ramaco, which is a little met coal producer in West Virginia, but they're sitting on this rare earth project in Wyoming, which is in carbon ore. It's not in hard rock. They think it's a lot easier to process. They are waiting to release a report from Fluor. It was a pretty good indication that the guy who was running critical minerals for Fluor resigned and joined Ramaco to run this project. So I'm assuming that the economics of the project are pretty good. He also left Australia to move to Wyoming to do that. Based on the resource base that we're put out for the project, is you're pretty equivalent on size as MP. Now, I did really enjoy the rare earth pod you guys did and talk about the trouble with the processing and whatnot. You are paying a very small amount. I mean, the market cap for this company has gone from 500 when I got in to was probably like 650 now. On an equivalent basis to MP right now, because MP's valuation is absolutely absurd, this project is worth like $80 a share on a $12 stock. The base coal business is worth like $9 at the moment. Highly asymmetric. It may not work at all, maybe a total dud, but they are going to be releasing that report. They're doing a ribbon cutting ceremony in a couple of weeks with a bunch of federal officials. 2 months ago now, Joe Manchin, who was a U.S. senator, joined the board of the company. But it's an interesting idea. I don't know that's going to work, but
you're the only person that's pitched a Wyoming coal stock as a rare earth, like asymmetric trade. But it's kind of funny because these coal guys must get like rare earth FOMO. Like they want a sexy commodity because like Whitehaven was a top 20 shareholder in Brazilian rare earths IPO. Like, yeah, I don't know. These coal guys just want to be relevant and important to the politicians. That's
They got to do something.
yeah, they do. Hopefully it works.
Dave, this has been fascinating and super insightful into a world we don't understand too much about. So thank you for sharing your time with us.
Yeah, of course. That was helpful.
Thanks so much, mate.
Awesome. How good was that, mate? I was stoked to share that conversation. And thanks again to Dave Sparks for joining us. A massive thank you also to Mineral Mining Services, Grounded, Sandvik Ground Support, and Cross Boundary Energy.
Hoodaroo.
Hoodaroo.
Now remember, I'm an idiot, JD's an idiot. If you thought any of this was anything other than entertainment, you're an idiot and you need to read out a disclaimer.